the guy in the night picking things off as it tries to cross the bridge or cross the moat or climb up the castle walls. That's my archer. I thought it was pretty cool. My 9-year-old picked that one out. Property valuation. Again, these are no necessary order, and like I joked, there is no quiz. But a lot of these issues are, to me, very pertinent to what we do as real estate investors, and therefore I try to put them all together, at least in a venue that we can discuss them accordingly. Anybody remember even, gosh, recently, it's 8-10 years ago, you'd buy a property, whether it be your home or whether it be a rental property, you call the insurance agent, and the insurance agent more often than not would say, well, what'd you pay for it? And a few days later, you get a policy in the mail, and that was it. And then remember these things called Hugo and Andrew, and then, you know, here in Cincinnati, we dealt with Ike. But a lot of the issues became that a lot of the old insurance policies had the old guaranteed replacement costs. The problem was the insurance companies were collecting premiums based upon the amount of coverage that they sold the policy at. 10, 15, 20 years ago, you bought the property for $100 grand, there may have been an inflation clause built in. Problem is, they were guaranteeing that they were replacing them. Hurricane Hugo would blow through, Hurricane Andrew would blow through, and instead of just having to replace a couple properties, they were replacing hundreds of thousands of properties. And don't get me wrong, I'm an insurance agent, licensed agent in about 41 different states, and been involved in the business more than 20 years actually. But, you know, I'm not as fan of the insurance companies anymore than anybody else is. But bottom line is they're for-profit businesses. So the whole theory of insurance, the theory of indemnification is put that money in the bucket, the insurance bucket, and when people need it, it gets paid out. The problem is if there's not enough money going in the bucket to offset the risk that's out there, that's why this whole changes over the last few years. You've seen companies come out and send inspectors out left and right. You've seen a lot of companies going back and reevaluating the books of business that they have insured. And that's why the reason for a lot of these quote-unquote recent changes to the process. The days of just throwing $100,000 on that property without looking at it a little bit harder from the insurance company's perspective are really over. Now, I just talked a little bit about which is best for you is really a decision that you have to make with a little bit of advice. People say to me all the time, well, I paid $100 grand for it. Why don't we just put $100 grand on it? Well, unfortunately, the insurance industry has built their rules. Anybody heard of Marshall, Swift and Beck? Marshall and Swift? They do replacement cost evaluations. They do building cost evaluations. Well, that, in a nutshell, is the starting point with most insurance companies and with most agents is they're going to take that property, and I know people that call my office and talk to me, I say, well, hey, just give me the address. Well, the auditor's websites today, I'm not going to the auditor's website more often. I'm not going there to find what the tax bill was on it. I'm going there to find square footage, construction type, year of construction, because I'm going to take that basic information and I'm going to dump it into that Marshall and Swift system. And I'm going to start building what it would cost to replace that or reconstruct that property in the event that it's blown away or is gutted in a fire. And that's how it starts, is what it would cost to replace it. Unfortunately, the word replacement and the word reconstruction are used interchangeably, and technically they're two different things. If you think of that 3,500 square foot two-family down in Clifton that you paid $100 grand for,